me a second. Hey guys, welcome Billionaire Acquisition Mastermind, the number one M&A group in the world. And we're here with Ali Tarafdar, and he's going to provide us some insights on business credit and other areas. So Ali, if you could introduce yourself very briefly.
Yeah, thank you. My name is Ali Tarafdar. As Valentino said, I actually come from an investment banking background. I started my career in 2007 all the way up to 2011. I was working in a boutique practice. I did a lot of debt restructuring, loan modifications, debt arbitrage at a highest level, when it comes to institutional investing. And of course, through that experience and learning how people were getting hurt, basically the customers, the end product, I decided to dedicate my craft to learning credit like no others. And I obviously run a small YouTube channel educating people on personal credit, but also business credit. I do a lot of turnaround work for distressed companies and those even healthy. And I have a network of investors in our inner circle that we look for healthy businesses. And if they're distressed, then we look to add value and take them to a meaningful level.
Amazing, sounds great. So let's get started. I want to touch on building business credit. Why is it important? So we got two aspects of credit. We have personal credit, we have business credit, Ali. When we look to acquire a business, personal credit comes into play. So if you could touch a little on that.
Yeah, no problem. Yeah, so the average American really, when they look at starting a business or company, they first like to tap into what they already have. They don't like to be going towards like unknown territories because it scares them. The idea of thinking about business credit is already kind of very scary because you don't know how to navigate that space properly. So my objective was really to bring together infrastructure where, as you start a business, a lot of people start to take on personal liabilities that are not necessary, like personal guarantees and so on and so forth. The aspect of business credit really comes in handy as you start to scale your business, as you start to, even if you haven't scaled it, if you're starting something fresh, starting to build those creditor vendor relationships at the get-go, building up a Dun and Bradstreet, which is the business credit rating scores, understanding the credit bureaus and how they function, and understanding on how to financially engineer a business is one of the fine arts of an entrepreneur. I think it's one of those critical components of a business that's kind of has to be included in a business plan, because the extension of those credit, like what happens over time, is you're able to scale much faster because you have access to those liquidities. And obviously, Valentino, you and I talked about this, where it's not just a question of having the credit, but you also need to understand how to service that debt, right? Because it starts to, exactly. So it starts to play, hand in hand. Yeah, like you need two hands to clap, cash flow and work hand in hand. But business credit really is something that's quite unknown to a lot of people. And I think that, we have to give it the significance that it needs to be given, especially if you're a startup, if you're looking to scale, if you're looking to grow. It's one of the best ways in terms of making underwriting for any large type of funding in the future as smooth as possible.
Yeah, absolutely. Now, it's not just about building the credit, but maintaining that credit, right? One thing I want to touch on is that in regards to your ability to service debt and credit, yeah, the better the credit score, the higher the chance of getting that loan. But there's also limits to it. I know my grandma, she had a really great score in the 800s, but it was because she wouldn't take out loans. Very cautious in regards to it, because she didn't have the best salary or income. She couldn't get the house she wanted. So apart from credit is also the cash flow, right, Ali? Can you touch on that?
And just to touch on that story at a personal level, when we're buying businesses, obviously, being in billionaire acquisition mastermind here, like you guys are a network of people who are looking to buying in business and trying to grow your portfolio businesses. The biggest thing that we have to understand is, as we look at financial documents and the servicing aspect of debt from debt perspective, like debt servicing ratio, we have to take those same scope of analytics and the same scope as we would look through as a business into the aspect of a personal. Fact of the matter is, it's a lot more strict on a personal level, because when you go to a business like a funding source where you're looking to expand capital or obtain funding on behalf of your business, flexibility around lenders around that area is a lot higher. But for example, if you were to get credit for, like, let's say Amazon, on a personal level, you'd be limited. But if you had a pretty decent business credit built, even if you were to use your name on it, the ability to get like 10 to 20 times more credit on the Amazon account, the same one with a business, is a lot more likely. So it's just a perspective of like, look, when you're having to, obviously maintaining credit is important. It's not that you don't have to use the debt if you have it, if you don't have the cash flow. It's a question of exercising your credit muscles. Sometimes we look at, cash flow issues or things that kind of stop us from getting the, nice, amazing mortgages, or if you want to move into a home. But also at the same time, I think the aspect here is you can actually get, if you have a decent credit score, if you look at the interest differences, sometimes just the interest differences is the affordability factor in a mortgage, right? So if your score is really high and the difference of payment is $600 because of a 200 score increase, that could be the difference between you don't have enough income to where you have the sufficient credit score to get that same mortgage, right? So these are some of the components that a lot of consumers are not necessarily aware of. But at the same time, like it's important that we educate ourselves around these elements, because if you don't have the cash flow, you have to subtract that with a better credit score to compromise for the lack of cash flow, therefore. And that means that a better interest rate comes from having a financially engineered, well-rounded credit score that has been exercised over time. I hope that makes sense.
Yeah, absolutely. Now let's touch on what is the importance of credit when we look to acquire a business. So we look to finance these transactions with the cash flow of the business, but if the business doesn't have a good credit, is that a possibility?
Yeah. So if you're asking in a sense that like if you have an existing LLC and or S corp or whatnot, and you're looking to buy an existing business with it, and you don't have decent credit on it, a lot of the fallback for what's lacking will definitely go into your personal side. So the banks and financial institutions are always looking for a way to secure themselves, obviously, right? They're in the business of security and risk mitigation. But I always, let's say if you don't have the credit that's necessary to execute a strategy to build or you don't have a strong enough business credit, if you can extend that closing date, let's assume like another 3 months, and I know, we're in it to speed of implementation, but if you're in a process where you're doing an acquisition, you could kind of extend that closing date for at least 90 to 120 days. What happens is you can start to leverage your business credit real quickly and then take that back to the underwriting desk after 3 to 4 months, where you have a little bit more of a solid standing on a business level. But if you don't have that, and if you're not in a flexibility time crunch, like you don't have the ability to extend that closing date, my recommendation is you got to make sure your personal credit is damn solid, right? Because it all boils down to that. But what happens now is you might have to also compensate by adding assets on a personal level, just because you don't have that business credit, right? So these things do happen. So it's an equation at the end of the day, and part of that equation is this is the final product. What do you have that can complete the equation? The more you lean towards the business credit side and the less on a personal guarantee side, and of course that means that you can now start subtracting assets from the equation, the better for you, because now you're de-risking the transaction that you're taking on. Does that make sense?
Yeah, great. What about if the business you're looking to acquire doesn't have the greatest credit score? How can that affect the transaction?
Mm. Yeah, that's amazing, man. Right. So if the business you're acquiring, because I know the acquisition strategies that we all discuss and we love to use is, you're going based on funding, based on the existing business that you're buying, based on its credentials, based on its performance. What happens is, exactly. So what happens is if the business is healthy, it has the cash flow, but doesn't necessarily have the credit. The beautiful thing is you can still work that credit factor in, right? So a good example of this is you can somehow get the transaction completed through the creative financial engineering that we do here in this amazing group. But obviously the better thing to do is once you're in it, improve the credit facility if you can, improve the ability that the business can obtain more credit and how it obtains that credit. So my priority would be, like we have the first 100 days or the structures that we leverage within that first couple of weeks that you're in the business and you're delegating to proper management in reference to making sure the business is running appropriately and you're doing your turnaround work. Make sure you give it a very important focus on the element of, okay, well, outside of this, to enhance the financial engineering component, to make the business even more valuable to the lenders down the road, and to have the ability to expand as quickly as we possibly can, we need to dedicate time to building that business credit once we're in. And that should be part of the game plan, I believe, on a foundational level to do the acquisition.
Ali, someone asked, what if you don't have the best credit but look to acquire a business? Can you get someone to sign off for you?
Yeah, and it's kind of crazy though because the United States is full of opportunities, and there's like literally a bank opening every other day. The beautiful thing is, yeah, you can definitely get a personal guarantor, they can sign off on your behalf if they have the credentials that's necessary for underwriting. You spoke to Josh, an amazing friend of mine, business partner who talked about accounting practices, obviously on valuation. I did a program called PG Shield, which is a personal guarantee shield. And what that is unlike the United Kingdom, we have personal guarantee insurance. You don't have that flexibility in North America. So PG Shield, what it's designed to do is, let's say if you take on board some to help co-sign for you because you obviously don't have the necessary credentials for underwriting on a personal credit level. What we do is we make sure that if something goes wrong, that the type of credit we obtain to optimize the capital events of getting into that business is kind of mitigated in terms of asset protection level. And what we do is we go through an asset search for that individual. We see how their assets are placed, et cetera, and we try to create an infrastructure that can support the current underwriting requirements, in addition to making sure that credit is preserved. Now, let's say this goes south and the business somehow, obviously it's a world of business and uncertainty and dynamics. But let's say something does go south and the credit takes a hit. The PG Shield ensures that we can take them back to where they were with a designated program for a few months. We get rid of the negative. We help them improve the positive stuff. We enhance the existing credit they have and bring them up to spec in a matter of 6 to 9 months. Yes. Yeah, I can hear you. Yeah. Yeah, that's correct. Yeah. Yeah. So the goal of PG Shield is to, yeah, can you hear me? Okay. Okay. Perfect. Yeah. So the goal of PG Shield, Valentino, and those who are listening, is simply to protect and preserve the personal assets of the individual signing. Obviously, we go through an asset search and we create a strategy. But on the other side of things is, let's say their personal credit does take a hit because the transaction somehow didn't pan out to our expectations. We can help them restore that credit in a matter of months with a designated strategy. So PG Shield covers that. There's obviously, it's a great structure for understanding like, hey, individuals are protected under this realm, even if they were to co-sign for you. But you'd have so many different components to it, right? For example, the deal was amazing. You're just lacking those credentials. But at the same time, not only is the deal amazing, we'll offer the PG Shield element to protect your personal credit and somehow restructure your assets so that you're protected from obvious lawsuits or litigation. So those are the two things that we love to do for people.
Is that you use?
Yeah, sure, man. So, let's look at the industry back in 2008 on this one. The housing market crisis, obviously the most exciting time for all of us, I'm sure. So when a lot of banks went south, there was a lot of non-performing notes that were left in the market. So that was a business model that we would go after. The one strategy that we had, like we talked about PG Shield, was financial engineering on a personal credit level. So we create educational platforms to be able to enhance the people's credit. And we bought a lot of non-performing notes. So the turnaround aspect of it was putting in management teams in place to be able to understand why the debts weren't performing, what are some of the financial ratios we need to cover in order to make sure that they were serviceable again, and how much of that serviceable ratio can we implement when it comes to the overall portfolio. So we'd buy debt like at 25 to 27 cents on the dollar at the time. But by the time we were done servicing them, which took about 6 to 7 months, we were performing at 57 to 58, I believe, at that time, which was amazing. And we were able to leverage that and sell it back to third-party lenders and private lenders. That was one of those implementation strategies that I think is critical. So it's like understanding the math between what's missing in the equation. How come these things didn't work? And obviously it was like, all guns being trying to get underwriting done. Mortgage brokers were going crazy, offering loans to pretty much dogs and cats as well, to the point where people are left, out of their homes into crazy apartments, and then basically restructuring their portfolio of loans and offering up a servicing aspect of it. Say, look, we'll make it more affordable. We'll fix your personal credit and get back on your feet in a matter of months. And that ultimately creates better economies of scale for everybody. But that was an amazing turnaround experience for me. And from that, I learned to negotiate a lot of personal debt, business debt. Just that whole experience was very fruitful.
All right, perfect. Appreciate that. So, as far as regarding financial enhancement, what could we implement post transactions to make sure the books are good? Implementing GAAP accounting principles. Can you comment a little bit on that?
Yeah, sure. So just a disclosure, I'm not a CPA, but I do work with a hell lot of them and attorneys.
Of course.
So look, the minute you take over, and great question, by the way, Nancy. So the minute you take over this business, your priority should always be standardizing procedures of accounting, right? And what I mean by standardizing procedures of accounting is now you know how the process on how transactions are done, right? How money goes out from the account, how money comes back in. Understanding the rules and regulations around that, having clear processes in place, and training your executive team and management team to learn how to handle that. Right? What are some of the things you can say no to, and what are some of the things you can say yes to? And if you say yes to those accounting structures or spending structures, or let's say investment vehicles, what are some of the checks and balances that need to go in place? So I think the most important thing is having a governance policy around spending is the number one thing you need to do as you start to get into a transaction or that transaction in the first couple of weeks. Once you have a clear governance policy on how money should be spent, the next is, what are some of the obvious risks we're willing to take and what are some of the things we're not willing to take? And sitting down with the team to discuss the ins and outs of that and really refining that governance policy and implementing it in the record of your business activities on a day-to-day basis. Does that make sense?
Yeah, yeah, absolutely. But what if, because I've worked with some accountants that, well, they've actually sit on our board and they're like, well, they don't use GAAP principles. Would that be an issue? GAAP principles, is that something that's absolutely necessary to go by, or is there another way, to go about doing things when we acquire these businesses, as far as the accounting wise, as far as the financials, keeping the books of the businesses that we acquire, making sure that everything's performing as it should be, and even more. So is GAAP principle, is that the end all be all?
Yeah, that's a very good question. So GAAP principle is really, the standardized process of accounting on a public record basis. Like for, let's say, if you're going to go public or if you're going to sell it to a hedge fund or a private equity at a larger scale. But you don't necessarily have to stick to those specific principles. Maybe you have a more tight governing principle around the accounting, right? Maybe it's much more enhanced. Maybe there's a lot more processes and controls based on your own existing principles of accounting. So it's not necessarily that it has to be written in stone that you have to follow that standardized practice. You can definitely go and sway your own way. However, just keep in mind that you can adapt things from GAAP to ensure that compliance is pretty much tight, right? And that your accounting and bookkeeping and all these stuff that you do in terms of, like I said, investing, spending, and some of the delegation of capital, like they're pretty much tight knit so that you have more control over these aspects and then enhance on that and tweak it as necessary as you grow.
Perfect. We got a question from one of our listeners. They ask, what about business lines of credit versus asset-based lending? Is it better to work with the bank that the business cash flow is going through, or is there better institutions that are more open? Let me read that again. I'm sorry. What about business lines of credit versus asset-based lending? Is it better to work with a bank that the business cash flow is going through, or is there better institutions, that are more open?
Yeah, that's an amazing question. And that actually can be answered in twofold, right? The first is the size of your business. It's an important thing to consider. Like, for example, there are small to medium-sized lending practices and institutions, like major tier one institutions like Bank of America, US Bank, et cetera, et cetera. Those financial institutions have a tendency to lean towards commercial lending at a larger scale based on the cash flow of your business. And they give you a little bit more discretion in terms of what you can borrow and the available credit that you have. But you have to have a sizable business also on that side to qualify. But if you're a smaller business, like a small mom and pop operation that you're just starting off, then the best thing to do is you got to go based on, let's say your personal credit or your business credit. Now, when it comes to asset-based lending, technically any institutional lending sources can offer you that. The only thing is you have to be very careful as to some of the clauses that are in that agreement that can potentially hurt your business from exit, right? For example, there is like a prepayment penalty structure that's put in place automatically, right? There's lending provisions in there that say, well, you can't use that money for certain things, or you cannot, you have to have a certain liquidity requirement met at all times in your account before you can qualify this amount. So you have to be very careful as to the institution you go with. But my preference to be honest with you, is go to commercial route where your cash flow of the business can sustain the available, credit that you want to borrow, like the debt servicing aspect ratio we talked about with Mr. Valentino. So my preferential route is that I would stay away from asset-based lending as much as I possibly can, unless absolutely necessary. And if necessary, a portion of my business financing comes from assets, right? Unless you're doing a major acquisition on leverage.
Okay. So what are the top things to do after we acquire a business? Day one.
Yes.
What are we looking at? What kind of volatility should we expect?
Right. That's an amazing question. So this is based on, like, let's say any type of business, right? It's not necessarily agnostic.
Right. Any business. Day one.
Oh man, this is the most important question, if anything. Day one, before you even get there, day one is the transitioning period between the web of networks and the relationships that business already had. And what I say by observe the web, customers that were there, how do they feel about this whole transition? Your suppliers and vendors, how willing and able are they to be flexible with you? The existing, let's say real estate that's within that business, the landlord, the management company, et cetera, your banks, the institutions that are already heavily involved with that business. Maybe partners that are there that haven't been, reached out to or haven't been communicated with because of some sort of distaste in the past or so on and so forth. So when you step into the business, day one, and the most important thing, of course, your employees, but from day one, when you step into the business, understand the web that you're stepping into and the type of network that web contains, and understand, do you have the same synergy as that existing business owner that you're taking it from? How do the parties feel about that? Are there alignment of values? Are there things that you can do that would enhance the lifestyle of the existing employees to make it a little bit more fun, to get them re-energized and re-motivated to take on the business to new heights? Obviously, unless you're replacing senior management there. But even at that, the more people you bring onto a family table that's completely different and from the outside, and the family table is, like I said, vendors, suppliers, customers, employees, et cetera, the whole web of relationships, the more crucial it is to understand the dynamics of that environment and understand the alignment of interest. If you don't have that, no amount of money can buy loyalty. Just keep that in mind. So you have to be very critical in reference to how you handle that. And my advice here is be as authentic, as real as you can, and initiate the value from day one and your interest and intent to make sure that everybody can work together with the clear synergies in mind so that everyone can benefit from this transaction, right? So that's my number one advice from day one.
And then just to add on that, it's very important to maintain, like you said, authenticity, and just be transparent, basically, from the higher level of management all the way down to the lower level of management. I think that's extremely important too. So you're an investor, right? So let's just talk about a little bit more about PPMs. I think some of our listeners want to know about that. When exactly do you need a PPM? Because I have a couple investors personally who's asked for a PPM from us. My M&A attorney says, well, why do we need a PPM? Because we're only going after accredited investors. So can you touch on that a little bit more? When do you need a PPM? Do you need it if you're going after, guys who are not accredited, or is that a universal thing for any investor? Also, I'm aware that's a lengthy document, right? So if we don't have to come up with a PPM, we want to avoid that because a good attorney is going to charge you about 20 grand for it, right? And we want to avoid that overhead if necessary. So let's just touch a bit more about that from your experience.
Yeah, that's an amazing question, actually. So as an investor, right, like I look at small to medium-sized companies, but I've already made large investments in the past as well. And the number one thing I look for, and why most accredited investors, even at the high net worth individuals, ask for PPMs, it's because that's a standardized protocol. It's like you go into a bank and you're asking for funding. And I'm not saying that I agree with you, Nancy, that it is very lengthy and it does take time and it does take capital. But let's assume that you are going to an institution that's reputable, that wants to give you money, but they need to understand the plan. They need to see the ins and outs of the exact capital structure that you're going to be deploying to maintain the liquidity that you will soon receive, hopefully, through underwriting with that institution. So an investor, on the scope of an investor, the way we look at it is, okay, well, look, if the person doesn't have the time and the commitment necessary to create an infrastructure that is basically the simple principle of a business plan, but on the investment side of things, which is considered the private placement memorandum here, then the likelihood of them being serious with everything else is not as likely. But that can be torped easily by the business principles and the management team and how while the business is performing. I think the biggest thing though, and even if they say, well, we're going after accredited investors and attorneys, we don't need that. The reality is to protect yourself, you want to file with the SEC. You want to file a Regulation D 506C, whatever the case, if you want to go through accredited investors on a global scale. And you want to make sure that you have the memorandums drafted. Now, you can have a simplified PowerPoint style memorandum as long as the full disclosures are there. It doesn't have to be expensive. The most important thing I say is, as any business, treat it as an institutional business. You're not going after capital. You're going after human beings that understand the game of money. So you have to make sure that you're well prepared for that. First impressions, like Mr. Pena would say, first impressions, you only have that one chance, right? So what you need to understand here is the private placement memorandum is not an absolute thing, but your full disclosure from that memorandum, the components of that, understand it very well, understand how to present that information. I go through something called a master due diligence questionnaire that I give all my advisors who are bringing and sourcing deals to me and the network of my families, centimillionaire, billionaire families that I deal with. The one thing that we look for is the complete thorough analysis of their business from day one. And whether or not they were documented from the get-go and how much time it takes for them to present that information to us based on when it was requested. If it takes longer, that means they were ill prepared. That means they don't have structures or systems. But if they can bring it within a matter of days or sometimes a week, I know for a fact that, okay, well, they're pretty much reliable and they've answered everything. And we look through the holes of that document to see if there's anything missing. And we try to help them out. Obviously, if we don't invest in them, we're not going to just say, oh, we don't want to do it and buy. We try to give them direction because maybe they have good intent to do something. And we know wholeheartedly that they believe in their business and they're taking their best will and goodwill to go ahead and get that capital so that they can take it further. So not necessary that you have 100% of the PPM, but understand the disclosures within that PPM that are critical. And if presented, I would still go with the Regulation D 506. And the reason I say that is because you still want to stay safe under the scope of the Securities and Exchange Commission, because being compliant shows commitment towards being safe with capital invested, and it's not going to be tied up in litigation because of the SEC, and therefore the investment capital is stagnant and therefore it's not moving, right? So that's just my 2 cents on it.
Is that a 506B, right?
Yeah, so the B is basically it's a 506C, Regulation 506C for accredited investors that you can market generally.
I'm sorry. Yes.
No problem.
Yeah, perfect. So we have some questions from our listeners, but just real quick, I just want to touch on something else relating to this topic. We did a series, a founders round of 5 million. We had one investor who was going to supply us with 3 million. He wanted 30% of the company. Ultimately, I had some board members who said, take the check and run. And I had some guys who were like, are you willing to give up that much equity starting out? Ultimately, I rejected it. I'm aware that, you can get investors to basically, without filing with the SEC at first, but basically kind of pledge an amount, right? And say, hey, for your acquisitions, where I'm willing to back you, with an amount or whatever the case is. If you're doing a Series A founders round, you could actually, get these guys to pledge some kind of amount and get them to sign an LOI. Is that something that you've seen?
So is the question like whether that needs to be registered or under the SEC?
No. Right. Is that something common, when going out raising funds for any purpose, that you get these guys to pledge an amount before you file with the SEC, just to get basically let's say a lead investor, right, or just to gain or gauge interest in the market, with the investors that you're shopping the deal around. Is that something that's common, in the finance world?
Yeah, 100%. Nancy, and that's a great insight there and question. And the reality is, look, if you have letters of intent or commitments that are drawn up to support your business, and even though the money hasn't moved or perhaps they just committed and it's just not there yet, it's like a private equity division. You have liquidity clawback, and you have lockups. Lockups are essentially, we have investors that are aligned. We have a 24-month time to call that money, or let's say 6-month time, or whatever the case. And you have a private equity fund that you can have $1 billion in commitment, but not a single dollar has moved yet. Because it hasn't moved in and come into your hands in your possession, the requirement for disclosure is not necessary. It's a commitment. It's a letter of intent, and it's probably a solid backing, albeit an intent letter. The perspective there is now, let's say if an investor does back you and has operational insights and wants to offer more value, as I like to do when I'm investing in companies, the most important thing there is it's no longer an investment anymore. It's a partnership structure. And therefore, the SEC doesn't have to come in and put its nose there and require the aspect of diligence there. So there are ways to do it. But like private equity, as I explained, if you have commitments that are not necessarily transpired yet or haven't really moved from one hand to the other, you're still playing it safe. You're good to go. Just understand this. When you're filing with the SEC, you're filing documentation because you have investors that are going to be passive, that are just putting in money to expect a certain return, whether it's on equity or whatever the case. But because you're selling your business shares for that equity and capital in exchange for a passive investment, anytime anything's passive and not active, automatically becomes it's precluded within that SEC filing disclosure requirements, right? So commitments don't necessarily add up to liquidity transfer. So therefore, you're still playing it safe while you're having those letters of intent signed and commitment signed.
Yeah, perfect. And just one last thing on this topic. Would you say that 30% or 3 million and 30% equity, in your experience, how would you rate that? Would that be a good deal? And as an investor, is that something you would offer? And if so, why would you offer that?
Yeah, that's an amazing question. So again, it really would depend on what the deal was and what was offered and what's at stake. But let's assume that it was a pretty reasonable deal. I would look at 30% equity. But here's the thing, like I want us to, on this call or whoever's listening, and hopefully in the future when they're watching this replay, I want people to get comfortable around negotiating. Right? An investor is like a business partner. It's as simple as that. What do they bring to the table outside of liquidity? Because you can create liquidity and have passive investors and have somebody's 401k, rolled over, and you can directly do an LLC and invest it directly as well, which, by the way, I specialize in with IRAs as well. But you don't necessarily need their investment capital. There's a dime a dozen. What's important is what do they bring to the table for that 30% stake? Exactly. Well, how is it going to help you to give up that kind of equity? Right. And if it's a huge opportunity that they want to ride on, and venture capitalists are very, very aggressive when it comes to that. It's like a group of vultures circling around a little mice. They want a lot of equity. The first thing I would ask is absolutely, I would love to give you as much equity, but what exactly can you do to the company to enhance my side of the equity so that it can go to the level that you're expecting it to go to? Because I have a company I want to run a certain way. And for me to be motivated to do so, I need your money to make sure that your money is going to be put to work a proper way. But at the same time, I want to know exactly how we can work together to take it to the scale that you expect. What will you bring to the table outside of, let's say, money? And and whoever it is that's investing can offer relationships, inner circle introductions, help you with economies of scale to reduce your costs within the business infrastructure because they have a web of other businesses that are falling into similar guidelines and industries. Then obviously, like the 30% stake, I would make the math work. Obviously, we talk about equation, and to me, everything is math. It's the equation. Then I would be willing to go ahead and give it up. Or me, if I were to go ahead and ask a 30% stake in the business, sometimes even 50%, depending on what I can offer to the table and why I see this is an important thing, outside of if it's just me or there's no other investors. Then I would expect to contribute outside not just money, but also resources. And of course, I would expect the delivery from the business owner's side to meet me halfway there as well, because I know the value that I can bring to the table. Hence, I want more equity because I believe in the business. So if it's just sake of equity for putting in money and there's no additional resources or value, I would look at that very carefully and say, okay, well, you're asking for too much equity. Can you offer me more than that? Or drop your equity down because it seems like I have to compensate by going and adding more to my equation and my side of the equation to make sure that I can match up to the expectation that I'm looking for. Does that make sense?
Yeah, of course. And lastly, in what scenario would we be able to negotiate with an investor to where they don't just look at us as, deal finders? What I mean by that is, how do we, of course, you said, build a relationship with the investor. And obviously, your lead investor is going to want to sit on your board in some capacity. But how do we maintain control of the company if he's writing the check, especially if it's the first check? How does that, in what scenario does that work? I guess basically gain respect from the investor.
Yeah, that's an amazing question. To gain respect from the investor, you got to bring something to the table that the investor is feeling like as though they're investing for the first time again. You got to put that spark in their eyes, right? And if the deal is not necessarily, and it's your first investor, and the deal is not necessarily attractive, but he's investing because he's got too much dry powder in the bank account, he really needs to get his money in order, and he just wants to do it for the sake of helping. At that time, the investor is not really looking for anything of a spark. He's just doing it because of the sake of asset allocation. And sometimes a decent business that presents itself in front of them might be the only reason why they're investing, which I know a lot of investors who do that, friends and partners of mine. But on the other side of things, it's like, okay, well, if I'm looking to invest with Mr. Mansi and Valentino here, amazing guys, they bring a lot of synergy to the table that I can see them dropping in to the management level and helping me out. And I'm not saying they're going to work day to day, but they can convince the management to take it to the whole new level. And they got resources that I respect, and they're out there doing the things that they're doing, and not just doing deal finding, but helping be very active in the leadership side of things. That really, amazes me in the way they conduct themselves and what they can create in terms of synergies. At that time, I think you got to offer the negotiation, right? But you have to know what you bring to the table. Number one, is it just another deal as a dime a dozen, right? Are there anything that you add to the table outside of leveraging and finding the deal structure together? Do you have a network of new customers that you're going to tap into? Do you have a network of referral partners? Do you have a network of suppliers or vendors that we can create large economies of scale? Can I gain anything from you and your relationships as an investor? Do you bring me other network of deals that I can introduce to my other investors and just keep the dialogue going? So there's just a whole lot of things to consider as a startup, or let's say not a startup, but if you're just trying to structure a deal and that's your first investor, those things have to be put on the table as a discussion basis. Does that make sense?
Yeah, yeah, absolutely. We have a question that came in from one of our listeners. They said, well, they asked, there are so many companies that advertise to build business credit, often with Dun and Bradstreet, and charge $3K. In your opinion, is it worth it?
Yeah, that's a good question. Actually, I have a program that charges $2,500, by the way, and you get to learn how to fix your personal credit. But that's not a pitch, right? The goal is, don't start to invest in business credit until you have a grasp of your personal, right? Like invest in your personal credit first, and then start the business credit. Now, create an LLC for the sake of, keeping something on the side, because when you do acquisitions, you will need a, special purpose acquisition vehicle. You'd much rather have business credit built on it as well, which has solid relationships. At a certain point in the future, you can sell that and you have more value. But I think that it's not a question of is it worth it to invest in business credit. It's a perspective of the likelihood of the need for business credit, which is very high. But what more are you getting from that? There are programs out there that are being sold for sure. But the question is like, how much are you willing to pay, and how much are you willing to learn, and how much are you willing to implement? I've seen programs that are $4,000, $8,000. The reason I kept it in mind at a low cost is because this is not my main source of income. I don't have to be greedy with it. I offer more value than a lot of other people who offer business credit courses. For example, asset protection and capital raising, $610 million of financial partnerships in a matter of a year back in 2011. So these type of things are necessary. So don't just look for business credit. Look for the economics around that, the dynamic around the business credit environment. What's necessary? Your personal credit needs to be intact. You need to understand how to protect your assets. You need to understand how to raise capital, how to do a deal. So don't just go after a business credit course. Go for an entire business, structure and infrastructure of a suite that can give you that 360. I hope that makes sense.
Yeah, yeah, absolutely. And we have another question. They ask, is it better to work with a broker deal or an investment banking firm? And do they evaluate the deals the same?
That's a great question. So I got a financial investment banking firm that I've been with and working with, Del Morgan Company, actually out of Santa Monica, California, that have done over $350 billion of transaction. The difference between them and let's say a broker dealer is, they would ask for upfront fee and it's very large, right? Like you're not looking at like something small. If you're looking for a deal structure, you anticipate going into any deal that requires the assistance and automatic thought process of an investment bank. Start with a $500,000 price tag. Anything less than that, you anticipate far less results. And they're going to compromise and they're not going to be as serious to raise capital for you. That's the difference between an investment bank. Now, broker dealers are only there in place to help you, assuming you have everything intact already. The package is ready. Investor relations have been done a little bit. The broker dealers can just simply dial and call or press out whatever information they have to through the disclosures, through the network of people they have in the investors just to raise that capital. They want to do as least work as possible, and that's the role of broker dealers. It means that you get a fully prepared package ready to execute for capital raising with minimal effort. And that minimal effort requires a lot of preparation, right, on your side at the beginning. So my advice is start with an investment banking firm. because it is a high price tag, and we do, obviously I do capital raising for those individuals if I'm not investing directly through the network of family offices, centimillionaire, billionaire families that I deal with. And we will help you prepare all that. And we go through that insane structure that's necessary at the highest level of institutional capital investing. But my answer to you is there's two different distinct behaviors and characteristics and job responsibilities from broker dealers and obviously investment banks. You just have to identify, are you prepared? If so, broker dealers. If you're not prepared, you need to go through an executive process and start with investment banks. Now, when it comes to the question of valuation, that would have to be done through a proper audited financials, right? Like those are some of the things that an investment banking firm will help you set up, and they will go through a proper appraisal process that would bring the valuation up to spec and code that's necessary for institutional investors that investment banks have relationships with, including broker dealers, to be an acceptable standard of evaluation.
Perfect. Great. Appreciate it. So let me ask you this. We have a lot of guys that, obviously we're a group of individuals who buy businesses. Raising capital and closing the equity gap, because that's mostly what the issue is when it comes to, us getting the financing. Is that something you could assist us with and our members? And if it is, what would that look like?
Yeah, that's a great question. So, yeah, I definitely can help. And I'll be honest with you, like this is what I primarily did back in the days. That's how I got the network of the investors, and I eventually became one of them. The idea is what I look for is, remember we talked about what if it's your first investor and how do you negotiate? Remember that? So the important thing is, and I want us to think like, hey, if I'm gonna myself or any other people who would offer that service, you have to make sure to make their life easier, right? So if you can have the infrastructure that's necessary that creates like a very, AAA team that comes together, and all you guys are missing is that equity component, and we can clearly see the equation. Honestly, that's the only thing that's missing. And it's sad that we don't have that, and I'm very motivated to get that complete. I would fill that gap, because then the equation's complete and everybody goes through a happy, process of a transaction, and everybody goes their way and goes home happy. So the element here is I can help. And if there are certain missing gaps and stuff, and I have a consulting practice around that, right? Where there's certain elements that are necessarily not there, but need to be filled prior to the equation being more perfect at that point where just the equity is missing. That's a process that needs to be had as well, right? So when you bring a deal together and that's the only thing that's missing, then, the type of investors I bring to the table are not only very committed to helping the business and taking it to a whole new meaningful level, including the people within that team, but also they're looking for somebody who, like I said, gets them excited again. So we got to complete the equation, right? There has to be that fine balance. But if you don't have that, that's another side of things. Then let's work towards creating that, right? Let's create that choke point that's necessary to get that investor excited. So yes, I do help you guys with that. But most importantly, just keep those golden rules in mind. And I promise you it's going to be a whole lot easier to raise capital down the road.
Absolutely. So just real quick, let's just, if you don't mind, can we do like a mock-up scenario? Just a, what if situation, right?
Sure.
Just to give the audience a better overview of what that would actually look like. Okay. For example, I have a $4 million deal. And that's 1.6 with add backs. Again, we're keeping it extremely simple, hypothetical, of course, and this is assuming that due diligence went great. There's no, lawsuits, there's growth projected for the business, X, Y, Z, all the things that you guys would look for and more. So net's 1.6, bank is going to give me 80%. I need 20% equity injection in the deal. And I say, hey, we have 15, our offer is something like 15% APR, at pro rata subsidiary in the, stake in the subsidiary. You get was 20%, you get 20% in the subsidiary. If we don't hit that, 15% preferred return, if we don't get paid, if we hit, above that, 18% we partake in the excess 3%. What would I have to do to present, my deal to you for you to give us the 20% that we need? Kind of like a real world situation here.
That's an amazing question, and I'm glad that somebody's actually asking that, right? So here's the way I would look at it. First and foremost, okay, now you got bank financing lined up. That's amazing. You got a pretty decent ROI. I would look at the terms. That's the first thing. What are the terms that come with that? What are some of the most obvious risky terms? Label them out very clearly. What are some of the positive terms? Those things need to be included. Number one. Why? Because my capital is being now. Sorry,
What do
go
you
ahead.
mean by that? I'm sorry. What do you mean by the terms as far as like the terms of the deal between me, the buyer, and the seller?
No. I mean, like the
Okay.
terms of the
Okay.
lending institution that's offering the loan, right? Now, obviously, the terms between you, seller, buyer, that's between us. Like as we start becoming, partners in investment capital structure here. But I'm saying, like, if a bank is giving you money, what are some of the obvious terms that are coming with it? What are some of the risky concepts within those terms that we have to be careful with? Because now the money that I'm bringing to the table, including myself, let's say, I have to make sure that it's like, for example, if the bank restricts certain things and provisions, and my money's there, and then my money is the first at risk before the bank's money, for example. You know what I'm saying? So we gotta understand those very clearly. So the terms, the goods, the bads, very, very clearly highlighted. Number two, how when you go into like the business structure and you organize this deal. Now, explain to me, post structure of the deal after you get it in your hands. After, let's assume I give the money, or let's say one of my partners give the money. What's the couple of first days gonna look like? How's the synergies, right? So I need to know that. Remember we talked
Okay.
about the web of relationships?
Yes.
Like, so I need to see that very clearly. I need you to give me a breakdown of the customers that are in that business. I need you to give me a breakdown of the vendors and
All right.
suppliers.
All right. Let me give you that. Let me give you an example here.
Sure,
It's a
sure.
two-story practice, alternative medicine, room for growth. It works perfectly with OBGYNs. Why? Because if if a woman comes in, a patient comes in, she thinks she's pregnant, she's bleeding, find out she's not. Okay, obviously she doesn't need to be here. Send her to the alternative practice. Okay, the alternative practice, what happens is there's 7 empty rooms in that building. It's a freestanding building, right? It's in a great location, right? Anchor tenants around. So there's room for growth. We've been speaking with 3 additional physicians, pediatrician, dermatologist, and ophthalmologist to bring them in. Also, we want to spend 20K and convert one of the rooms into a vascular lab, right? And just giving you some of the vision we have for the business. Again, all hypothetically, of course, right? So what that kind of vision help?
Yeah, for sure. So that's basically like a clear, articulated post diligence business plan, right? What I'm asking for is essentially, this isn't necessary. Like these should be in the package of investing, like for investors, essentially, right? Outside of the bank terms, the team that you're working with, give me the web of relationships and the business plan. What I'm talking about more is like the concrete structure. Like, okay, well, how much risk is this? Like, I understand you guys are looking at hypotheticals and opportunistic scenarios of financing and getting a deal done by bridging that gap. But I need you to be fully transparent and give me the bad side of this. How can it go south fast? You see what I'm saying? So, and what are some of the repercussions to prevent that? What are some of the checks and balances in place? Is the team aligned with this kind of repercussions? So there's a whole lot of risk assessment that needs to be done prior to actually presenting that, and we need to be very confident and we have to have 100% conviction that this will work and it's tested in battle tested and tried. Does that make sense?
Yeah. So basically, it's not so much of how we're gonna make you money. It's more so how we're gonna not lose your money.
100%. So there's
Okay.
but it's true though. It's true. And this is important, right? Like, what's the job of a lawyer? And I'm not disrespecting the legal profession by any means, by the stretch of the imagination. I'm saying the lawyer's job is to say no. You see what I'm saying? The goal of underwriting is to say no. The select few and the rare will only get a yes. Why? It's because they understood the art of no. They understand the art of risk. So when you're presenting a deal structure, when you're getting money from any banks, financial institutions, individuals, angels, seed, venture, private family offices, multifamily, whatever the case, understand the art of risk. Understand how this can go so wrong that I can't even show my face to the community anymore. Right? So given that at the highest level of risk for me, what can I do to protect your capital? Because here's the 3 things that family offices at the highest institutional level of investing look for. The first primary goal is not return. They can make return every day by doing a spray and pray method, allocating a small piece of their asset or capital into venture firms that are very aggressive. And they don't have to worry about that. The number 1 goal is capital preservation. Number 2 goal is return, right? But also return with synergies. Because that return, I don't want it to go I don't want it to be derailed, right? Everybody's having a fun time and we're in the party train. Somebody goes crazy. everybody's at risk. I want to make sure that that return is created with proper synergies with alignment of interest. And the third thing I look for is opportunity to create influence. Right? How much of that investment is going into something that's meaningful that I can be proud of and support and back and introduce you to my family of dinner table as a business owner, right? So these are some of the things that we have to keep in mind. Rate of return, yeah, it's nice and fancy and everybody loves that. But capital preservation is the game. Understanding the art of no is the game. Understanding the art of risk is how you raise money. That's how it works, especially in Wall Street. It's going to continue to be so going forward. So I just wanted to give you guys that insight.
Yeah, perfect. Appreciate it. Absolutely. Another thing. So negotiating insights. Can you share with us negotiating insights with small business owners as they have a emotional tie, with their business? What's your experience with dealing with these kind of owners?
This is the most important question, actually, when it comes to negotiation. The first thing you want to know is, you have to be in their shoes. Like it may sound lame and corny, but the reality is when I say be in their shoes, let them speak it out. Let them speak it out. When you sit down with a business owner, be genuinely interested in their business. Don't look at it as a number, as 6-figure or 7-figure exit or potentially 8-figure exit for you because you're going to build wealth, because you want to be aggressive. The only time you're going to be aggressive is because the clouds are opening up for the sun to shine. You've put enough, how do we say, charisma and energy and radiant value in this world to allow that cloud to spread for you so that there is sunshine. Right? If you go in a room with a shroud of darkness around in the back of your head, making a lot of money quickly, you'll never pay attention to what the business owner is looking for. These are cues that we need to be very close attention to negotiate at their level. You need to make them very comfortable because they have a crocodile brain at the beginning, right? That's the first instinct. It's the mankind. It's the caveman era. Like that thing is the most dominant space in our head. You have to make sure that you speak at their language and you're very genuinely interested in their business and offer something of value that even if you walk away without a deal, that you feel happy that you've done something for them. And you have to express that interest and intent at the very beginning before you even start a conversation. And if they ask why, it's because I am studying the space and you guys are buying businesses all the time, and say, the more I know, the better. And if I can leave with an impact where there is an amicable departure between us, I'll be super happy. The moment you say that, all barriers are down, all the facade is down, full transparency opens up, the clouds are opening, you got a nice sunshine, let's go for a cruise. You see? So that's how it works. Now, once you have that, negotiation is not a perspective, well, can you do this because that? It's a perspective of, what do you think about this? Right? You have to learn how to rephrase the question to open up the creative mind of that individual so that they can agree with you, but let them give you the insights that they feel and acknowledge that feeling and try to nurture it towards the response that you're expecting on a reasonable level. Right? So that's how it works.
Yeah, and you saying that actually reminded me of one of my favorite books, an author, Dale Carnegie, How to Win Friends and Influence People. I'm not sure if it was the second chapter, but he says that if you want someone to do something for you, arise in eager want. And he also said that you can get someone to do anything you want if you just show a genuine interest in people. So I walk a lot of facilities every week, and prior to me going and meeting with the owner, I would usually look them up and see what I could find out about them. If it's basically a favorite football team, if they have some kind of hobby, I could see online, or just find out a bit more about the business, when it started, right? We have access to Dun & Bradstreet. We're able to see basically triggers, what kind of articles was published about the business, if any, right? And that gives me a great opener, if you will, when I approach them. We spend 30, 45 minutes sometimes, believe it or not, just speaking about the seller, not even about myself, but about the seller, their experience, right? Of course, they're going to sell you on the value of the business, but just aside from that, just show a genuine interest. And I would say 93%, 89 to 93% of the sellers that I interacted with would rather sell me their business versus the other guy, right? Just because of that approach alone. So I just wanted to, add to that.
100%, man. You nailed it. And that's the truth, right? Take the time to know them, because that's the only time you'll have, whatever time it takes within a short time frame to open up the opportunities of conversation and dialogue for that transaction.
Yeah, I mean, even back in my real estate days, I've gotten real estate deals where it's not the numbers that they agreed with; it's the rapport we built. So I believe in that 100%. Now, just going back to this, this is just a straightforward question. As an investor, with your background, how do you negotiate? Give us some insights on that.
Yeah, that's a very, you probably hear it for this side of the table for once, but let's just assume that I'm looking at a deal. The first thing I look at is, in my existing network, is there a similar deal that comes across the desk? And if so, in the last 90 days, is there something similar that I can basically, that I refuse to go to prior because I wasn't ready for it or committed? But because you brought me a deal that opened up my insights again, does the other deal look more attractive to me? And those are some of the things that I want to be asked on the other side, right? If I was investing in a deal, because the most important thing is understanding your investors as well, right? Yeah, you can present capital partners, you can present people in front of you, but I'd like to know, like, you actually know what I'm looking at, that you took the time to understand my appetite and cook me up a good meal, that you just didn't do it because you wanted my money. So those are important. Understand appetites, right? So if there's a deal that's similar and I passed on because it wasn't the right time for me, or it's just not, interested at the time, but because you brought something very insightful to me, like I said, you created that spark again. Maybe I look at the other deal now and I try to compare and contrast. And the reason why I say that is because these things happen all the time in an investment community. We look at a deal, we pass it on. We have dialogues with our inner circle, especially with these families. And then we get back to the table again. We say, well, look, there's a new deal that was presented. Obviously, there are some new insights that come into play. And now the time looks like it's a favorable opportunity for us. And what that does for me is, I know for a fact that if I can look at the other deal, that you brought something that's quite interesting, then I can create synergies between the both companies. Then probably I do a joint investment. I'll do one in yours and I'll do one in theirs. And that's for me de-risking myself with the same industry, but dollar cost averaging as quote unquote stock investing, but in a physical business scenario. So that's the first thing. Know what I'm looking for, understand my appetite, and understand that there will be opportunities that you present to me that'll re-spark my imagination or curiosity towards a deal that I passed on recently. That's the first thing. So knowing that, how can you make an irresistible offer that kind of twerps everything else that I've looked for? Like I said, be unique and creative and understand how to control that choke point. Second thing, that was the first. So I'm going to give you the top three, right? So that's the first thing. Understand the appetite. Second thing I look for is, what was the most recent activities that you've done as an individual who's presenting to me this deal? Right? How credible are you? Your pedigree. What do you bring to the table? Now, I understand deal structures and everything is fine, but I don't want to have a relationship where it's a one-time thing where I invest in your business because it's a great business and you offered me something amazing, and then we forget and we lose touch. I want to be doing less work as an investor. The lazy investing route is what we call it, right? So I want you to be very open about like the future of what it looks like outside of this deal. And a lot of people say, well, you shouldn't be pitching potential, right? But the reality is, if the deal makes sense and it's good and it's presented well, there's room for dialogue post that underwriting process where we look at the deal and in between. You should be excited about the future opportunities within the same vertical if I'm investing in that, and tell me what I can look forward to, because this is the type of work you're going to be putting in. I want to be a financial partner, not just an investor. And the third thing I would look for is, like de-risk, capital preservation strategies, those type of things. What can you do for me to meticulously mitigate that risk for me, right? And what are some of the checks and balances in place? If you cover those three things, understanding my appetite, that I'm looking for other deals and what you can do that makes it irresistible, understanding that I want to work less and have my money work for me, and that you're willing to back that insight for me, and then you're going to look out and do the things in my best interest within that same vertical to make it easier for me to invest in the future. And three, that you basically did everything in your power to protect my money and capital, then this is the pretty nice, surefire way of investing. The other thing you need to keep in mind, true investors who are not emotionally based when it comes to decision making and are, this is a bonus, are looking to invest in legitimate companies who offer value, don't like bidding wars. We don't want to be pinned against other investors. We don't care about that. We're going to take our time with due diligence, usually 60 plus hours or 70 hours, whatever the case on a deal. So those type of things have to be, kept in mind. And then past that, you got a pretty smooth ride ahead of you. Does that make sense, Hansi?
It makes absolute sense. Now, I would say one final question. One final question. And please excuse the question, but what's your comfort level when it comes to investing, and what capacity are you comfortable with? Again, excuse the question. Not to say you have a comfort zone, as investors. I know you guys don't, but like, in what capacity, are you comfortable with investing? What I mean by that is, okay, obviously a financial partner. You don't want it to be a one-time thing, and a lot of investors I've worked with, they have the same mentality. But in what capacity? Is it do you want to sit on the board of those individuals? And those individuals that bring you deals or that want to bring you deals, how necessary is it for them to have a board of their own? Or is it okay for an individual to say, hey, this is a deal I have, I found it, right? And they have everything put together, all the information that you wouldn't want to know, but they have no board behind them. So I guess that's kind of like a two-part question. How
No,
relevant is the board when it comes to getting financing and funding from investors?
yeah, that's a good one. Now, I understand the practice of getting a board in place is very, very critical. It is important because you are starting your, ventures and acquiring companies and obviously creating something of value. The one thing I would say though, if a board is willing to back you and they're willing to come on board and give you the advice and their, the framework of the amount of work they do and their professionalism and take the time out of their schedule to support you, I'm pretty sure you're well calibrated there, right? So it would show me a little bit of confidence there that, okay, well, he's got enough team members there and a board he put together that those people are willing to put their name on the line for. So I'm pretty sure that the individual is pretty covered there, right? And the other thing is the level of comfort that I gauge on, it really depends, man. So it can go anywhere from a minimum of 100K, right, liquidity wise, up to $5 million. Now, the reason I say that is because being a family office, like on a private level, the most important thing that we need to look at is, like I said, those three components I talked about, appetite, understanding, the elements of putting together a synergy and a deal that I know there's going to be an expansion of that vertical in the future with opportunities, and of course, capital preservation. But, a board is good. If you don't have it, it's not a big deal. What I would look then for as a recourse is the pedigree. If I were to ask peers within your circle about who you are, how much you did, I'll probably even look at your personal credit. Chances are the way you handle your money is the way you're going to handle everything else in our relationship, right? So I would just base, the due diligence element tightens when you have less. Like, remember our conversation about equation, right? Take equation to everything you do. So whatever you bring to the table, the more weight it has, the less heavier it is on you on a personal level. But also, like, those are the elements of investing. Now, why would I put 100 to 5 million? It depends, right? If the deal was really good, sometimes I co-invest with my partners. Sometimes it's just a direct investment, but very rarely would I do direct investing. And the reason I say that is because most of the investment I do is based on the synergies of families that I already have. They already have a good amount of investments that I'm looking for, and they're already part of it. But I can bring those families and co-invest with them, right? And I could say, well, what do you think about this? And they say, yeah, this makes sense, and we're aligned, and it goes well. So the appetite is from 100K to 5 million. And if you don't have a board, like I said, think about the equation. What do I need to do to compensate for that? And if you have a board, it doesn't mean you're excluded from those kind of due diligence structures. It means that there's less restrictions around that. But there is some things that you have to keep in mind when it comes to looking at investing. Does that answer it?
Yeah, absolutely. So I partially asked this earlier. Are you able to refer us to other people, other individuals like yourself?
Yeah, absolutely, man. Yeah. So what are you looking for exactly so that I know?
No, just for future reference, in the event that, anything came up, we needed some kind of professional or, somebody in that field. Just wondering if you would be able to connect with some professionals.
100%. Whatever you need, deal structure wise, or you just need some clarity on some deals, or maybe even capital, just reach out, man. I'll be more than happy to, especially if it's a good deal, as I said, and I'm down for it. Definitely help you guys out.
Hey, Ali,
Even
real quick.
even in the capacity of bringing other guys on, for an interview. Go ahead.
Yes, I wanted
For
to
sure.
ask that if you could refer us to other guys that to bring on interview. Like I said, we're looking to shine light and bring clarity to the M&A space.
100%. I'll be more than happy to. No problem.
I appreciate that.
So I guess I've said this a couple of times, but seriously, final question, and we just have to touch on this environment, COVID-19, or I don't know what it is by now. How do you see how do you see the market? Where do you see the market heading? Is it going up, or do you see going? Does it, in your perspective, is it going downhill from here?
Yeah, that's a very good one. Well, we have to say it the way it is, right? Like just stare at the line through its eyes, like eye sockets. Don't even look at its people. Go straight into its soul, and let's face it for what it is. It's a disaster and a half waiting to happen. Period. We know that, right? Not only is the biggest transfer of wealth, which was the old community of industrial age and people who are seniors who are retiring at an exponential rate, like 4,000 baby boomers retiring on a daily basis. Not only are their wealth transition or exits have been stagnated because of this COVID situation, or like you said, the mutated virus or whatever the case, but now you also have at an incremental rate young people or even people who are like generation millennial or people who are starting off that are just past the element of baby boomers who started their businesses and have been running it for like a couple of years are also being hurt in this process. So prior to the COVID, you already had issues, but now you got things that are pretty much happening all over. And I'm not trying to do this to scare anybody here. It's just that you have to face the reality for what it is, right? The quantitative easing can only go so far, right? People are going to look for risk processes and are going to look for creating wealth at a very exponential rate. You just have to be extremely careful as to how selectively you conduct yourself in this environment. Now, because of COVID, there's obviously a lot more restriction, a lot more circumstances where investors will be more opportunistic because money's not going anywhere for the most part. But at the same time, they're not completely unaware that there are going to be deals that are going to come across the desk that are not necessarily don't merit that kind of investment. So as an economy as a whole, I think that there's a great opportunity for people in the M&A space right now, especially us here. Or those listening, and of course, you and Valentino putting a great team together here. I think that there's a huge opportunity for us to step forward and take leadership in this element to do our part to restructure and add value and create that influence in the economics of small to medium-sized enterprises. The other side to it is the wealthy are only getting wealthier because vulture investing it is an all-time high. We're looking for distressed asset at an exponential rate. So we're going to find things that are dirt cheap that other people won't have the necessary resources, especially the middle class. We know that they're getting poorer. But at the same time, like to rebalance that equation requires drastic measures. Now, those drastic measures have to come from preservation of wealth, right? Not having businesses closed, filing bankruptcies at an exponential rate where it's backlogged in courts, but rather businesses that are being turned around, being salvaged, being, opportunities being created, new synergies being created to get that money cycling again. It's very, very important. So I think that it's downhill for most who don't know how to handle themselves or haven't been prepared for this. But for people who are opportunistic, we're in the space of acquiring, holding, and transforming companies for the greater good. It's a gold mine, right? So you just got to know where you stand.
Yeah, absolutely. So I think we're about good on questions. I don't see anything else from Facebook or YouTube. Yeah, I think we're pretty good. Hey, I really appreciate it, man. This was definitely a fire. One of the best ones. Valentino, let me know if you have any last remarks before we close.
Ali, I appreciate your time. I appreciate you reaching out to us. This was great insights for a lot of people. I'll follow up with you and send you the link and see if we could, get someone else for the next podcast. That'd be great.
Yeah, hey, no problem.
We have a weird question. I'm not sure if it pertains to you, but it's weird. Are you able to, or do you know anyone that's within your network that has access to a large email list? I believe this has to do with fintech.
Right. Yeah. So one of the biggest things to keep in mind, and I'm not saying this as a no, and that's an amazing question, and I'm going to try to help you guys out because I don't want you to do the wrong things out there and get hurt in the process. A relationship on an email list takes time to build. It's a very strong thing to have a strong relationship with an email list. It's a game-changing investment vehicle for those who have large email lists. So those generally with that kind of list are very, very careful as to how they share that list. And usually it takes even longer of a time to build a relationship with somebody who has a big list for them to extend their contacts to you. So generally speaking, most wouldn't offer that. And you can buy solo ads all you want and stuff like that. I had an ad agency back in the days when I was working with Google. So it's just something I know very well. But one of the most important things you guys need to understand is anybody with a list that has decent email subscribers that has been very on top of it to build those relationships and maintain it are not generally going to just let it out and just be shared because they're very critical in how they built that relationship in the first place. It took infrastructure, time to nurture those relationships and cycles to create the value out of it so that they can maximize that. So anybody who, let's say if you have a perfectly polished basket of apples, And you might have all the best intent, but sometimes an orange just doesn't fit in that basket of apples. It ruins the aesthetics. You see what I'm saying? So you guys have to be careful when you're looking for a list, or if you're looking for co-partnering and using somebody else's list. Understand the appetite, as I said. Understand what they do with their list and what kind of activities they do, and align yourself with that if you can, and then find your way in from there.
Yeah, absolutely. Makes sense. Makes sense. And I agree with you because I did some affiliate marketing and I've dealt with large lists. I mean, 500,000 to, over 1 million subscribers. And definitely they have to trust whatever product, you're trying to push on their subscribers, and they have to trust it. So yeah, just to add to that. So yeah, all in all, man, again, appreciate you coming on. This was definitely a fire episode. And I don't know what your availability is like, but I want to get with you, sometime maybe next week. I have something you may be interested in, aside from mergers and acquisition, of course, kind of like disruptive technology, if you will, man. You may like the concept.
Yeah,
have
man.
some other guys who are biting. I've already spoken to a IP attorney, just to protect it. I can't even mention the concept right now, like honestly, but I'm gonna get with you. I promise you, you will be interested. I've
No
even spoken
problem.
to the owner of Miami Children's Hospital. I'm in South Florida, obviously, and he thinks it's interesting. So, yeah, definitely want to talk to you about that.
That's amazing. Yeah, let's connect, man. Let's connect. I'll reach out to both you guys, and we'll stay in touch with this, and we'll take it to where it needs to go. No problem.
Ali, again, appreciate it, and I'll get back to you with the link, and let's move forward from there. Thanks again.
Thank you, gentlemen.
All right, take care. Bye. Number one M&A group in the world. That's a fact. You already know the number one, the only ones bringing true value, true insights. Real dudes have been there and done that. So disprove us.